Hey, what's going on Instagram? It's Sam here, and welcome to a kind of a new feature that I'm trying out on Monday afternoon stroke evenings on Instagram, which is my Monday mortgage melt. Basically, I thought of what day of the week has the same letter as the word mortgage, which is Monday, and then what can I put with mortgage and Monday to create something that sounds cool. So we've gone with melt, because basically the whole premise of this, I'm just going to wave to all the people that are joining me. Hi guys. Is that I'm actually gonna concentrate a session a week coming live onto Instagram. Hey Mortgage Sing, how you doing? To just talk about mortgages, so and related kind of products and things like bridging and development finance, stuff like that. So the premise of it really, as I said, is to answer people's questions. So if you're coming on and you've got any questions, ask them and I can answer them live, and this will sort of fuel the sort of discussion that we're trying to have. But otherwise, I will also have sort of things that I'm going to sort of try and cover, bits that have come up in the news, changes to products that are like pretty major and all that kind of stuff. So it's going to be kind of like a sort of a 20 minute, 25, 30 minute, they're not really sure how long they're going to last so far at the moment, but just really kind of breaking down news to do with property finance in general. So, kicking things off, one of the things that's happened in the last week is that Vida Home Loans have launched an 85% loan to value product for mortgages for limited company buy-to-lets, which is pretty major because number one, Vida are actually one of the lenders that decided to come out of the market during lockdown. Many were speculating it was because they had a bit of a problem with their funding lines, which is not great. Hey Tatiana, how are we doing? And they've decided to come back with a pretty major product. This is the first 85% loan to value mortgage product for buy-to-lets that we've had since lockdown. So you can speculate this in a couple of ways. Either it is a lender, a specialist lender. Vida are a specialist lender. They concentrate on people with adverse credit, and they also have specialist products for buy-to-let and that sort of stuff. Either they're just trying to make a mark. They're coming back, big product, making a bit of a splash, and just basically trying to get some market share by offering a higher loan to value product, or it's second charge news. I'll come on to that in a minute, Tatiana. I'll come on to that because this is quite relevant, because I'm doing quite a lot of second charges at the moment, which is pretty cool. But just capping off on the 85%. The other reason it could be is that lenders are starting to feel a little bit more comfortable with the market. We've been seeing a lot of residential mortgage lenders kind of increase their rates above 75% over the last couple of weeks. And what that's kind of meant or said to me is that lenders think there's going to be a dip, but they don't necessarily think there's going to be a crash, because they take certain contingencies into account when they're setting up their pricing structures, and they're thinking, okay, well look, if it's above 75%, it's starting to get a bit risky for us. We had a period of time where really, like, even up to 80-85% was still pretty decent. Then you got into the 90-95%, and then that's when they would shoot up. The fact that it goes all the way to 75% now suggests that lenders are thinking there's going to be a dip. So the fact that we've got a lender like Vida coming back for limited company buy-to-lets, 85%, I still think that they're just trying to go for a bit of market share here, trying to get some an influx of new deals, trying to get their call centers, their underwriters busy by getting this kind of product out. Hey Shaz, good to see you. So yeah, that was kind of a big bit of news that came out in the last week. But Tatiana's asked about second charges. Now this is quite interesting because we are doing quite a lot of second charges at the moment, and the reason that we're doing quite a lot of second charges is, and a lot of these are on buy-to-lets, by the way. In fact, I've got an inquiry Friday, it's Monday today. I have to remember, Monday mortgage melt, Monday, not Friday. they basically we were trying to figure out a way of getting some money together so that they can go as and when the dip, whenever that's going to happens. Literally, they'll be able to have some funds available in like a war chest. And originally we started chatting about bridging. Now, as anyone that follows me knows, I'm a massive fan of bridging. I don't get scared by the fact that the rates are a little bit higher. I don't compare bridging to, Tatiana, buy-to-let second charges. This is what I'm going to come on to. So I don't get scared by bridging. A lot of my clients don't get scared by bridging. I don't compare bridging to mortgages. They're completely different products. So, I don't compare the rates from one to the other because they mean completely separate things. They're a tool in order to help you progress and build your portfolio a lot quicker. But as an alternative to this, because what we were discussing originally with this client was that were going to buy a new buy-to-let to add to their portfolio, but they didn't really have a lot by way of a deposit. So what we were looking at was maybe doing a cross-collateralized bridge, where it'd be a first charge on the purchase, and then we would utilize the equity in the other property, which was buy-to-let, that was leveraged at about sort of 40%, to make up the difference. And we were saying, okay, well, that's all great and all well and good and everything, but the rate's going to be a bit, quite steep. And when you have a cross-collateralized loan where part is first charge, part is second charge, you're kind of going to blend those two rates together, and overall it's going to be a little bit more expensive because the risk on a second charge is higher than on a first charge. So we started talking about the idea of just putting a second charge on the other buy-to-let, because normally we might just refinance it, but they were stuck in a 5-year fixed rate and they've got 3 years left to run on their fixed rate. So we've gone, okay, well look, we'll just get a buy-to-let second charge on this property. We'll take it up to 75%. We've got money then waiting. We can go out and buy a property. In fact, what it actually added up to on this one was that they could actually go out and look for property where maybe they'd be only putting down, needing to get a bridge of about 50%. It just means that the cost of the funds is going to be so much less, and the ultimate goal is still achieved by way of getting purchasing a new property, basically following the buy, refurbish, refinance model. But that money isn't there to be repaid straight away, because this is the other thing you've got to think about with bridging is the exit strategy. And if you're doing a buy, refurbish, refinance model, like my good friends at CW Homes who've just joined, hi Simon, the exit is massively important. What you can get based on a 75% loan to value mortgage on the exit, that's got to cover you. That's got to cover to pay back the bridge, hopefully cover your deposit, and maybe even cover a proportion of the cost of the works and other fees and stuff like that as well. So you're pulling most of your money back out. Now imagine if that bridge was cross-collateralized over 2 properties. You're not looking at 70 or 75% of the purchase price. You're probably looking closer to 100% of the purchase price. Now, when you're looking at the exit to that, it suddenly becomes a little bit more tricky. And you're paying all that money back, and you're paying interest on all that money during the course of it, and it's bridging costs and everything like that. And then you've got to pay it back, and then you're kind of back at square one all over again. Now, the idea of doing this second charge, it kind of is a pool of funds that can then be used over and over and over again, because you don't have to pay that back like straight away. It's probably going to be on like between a 5 and a 15 year term. Okay, yeah, it'll be on a fixed rate for a short period of time, but it doesn't need to be repaid for 5 to 15 years, which takes the pressure off that process. You can actually start strategizing, and as long as you're good with your numbers and you can make sure that you pay everything off when you have to, and you make your monthly payments on it, that's crucial as well. That's money that you could use over and over and over again. Then you get to the end of your fixed rate on your buy to let. So in this instance, 3 more years to go. Get to that. We'll just refinance the entire thing together, and the whole thing will then be a first charge, and the rate will be a lot less than it would be on a second charge. So on a second charge might be 4.5%, 5%, something like that. The first charge might be 2.5%, 3%. Who knows, depending on what lender you're looking at. So can make quite a big difference. But as I said, the benefits of looking at it in this way are massive. And it always kind of shocks me when I see sort of lazy broking sometimes. It's like, yeah, just take out a bridge, cross-collateralized bridge. No. Let's look at the longer term here, and let's think about how we're actually going to repay this loan, how much needs to be repaid. Is the extra cost of the funds really going to dig into that profit margin? Because remember, if you're kind of trying to do the buy, refurbish, refinance model, every penny that you leave in has a negative effect on your return on investment. And if you're heading for a particular return on investment level, so maybe like 20-25% max, that's going to cause some problems where the more you borrow, the more it costs you. So if you can get to a stage where you're borrowing your deposit, and maybe it's 50% deposit on the new property that you're going to buy, then you only have to bridge that 50%. The cost of the bridge itself is just going to be so much less as well. So there's so many moving parts here, but so many things that are basically we're saying we're thinking outside the box a little bit here. So that was a really good question, Tatiana. Thanks ever so much for asking about that. But yeah, second charges are great. There's loads of options, and I personally, we're thinking we're not necessarily getting inquiries for them, shall we say, at the moment. What we're doing is we're thinking outside the box. We're getting the inquiry and we're thinking, because this is another thing. A lot of time when clients come to us, they say, I want this. And it's amazing how many times we don't end up actually doing that. And that's when it comes into, I've been doing this for about 13 years now, business partner about 10. And so between us, we've seen a fair amount of lots of different strategies. We're really lucky as well. We've got some insanely good clients in terms of how good they are as investors. And, we're really fortunate for that, massively fortunate, because number one, it actually allows us to see some of the stuff that they do creatively. The conversations that we have with some of these people is just amazing. It's almost like, I'm trying to think of the word, that I'm so grateful that we get basically a bit of a behind the scenes view as to how they see things, how they work things out, how creative they are. And like I said, I've used this phrase, thinking outside the box. They do a lot of it. And so we can see, a lot of these ideas are things that people have come to us with, or we've bounced off each other and brainstormed and come up with these things before. And then we can go, well, hang on a second. This is a great way of doing something that lots of people aren't doing, but now we can speak to other clients and talk to them about it as well. And this idea of the sort of second charge instead of cross-collateralizing a bridge is a great one, because the standard way of buying a property, if you don't have enough for the deposit and you've got equity elsewhere, is cross-collateralized. Well, why not look at a second charge instead? It could end up saving you a bit of cash. So right, so other things that we've been looking at this week that have been of particular interest. One that was pretty good was a commercial acquisition. Yes, absolutely, Tatiana, you've got my number. I think you do. If not, just ping me a message on here. I'm sure we can catch up. But another one was commercial premises, new commercial premises. But this was the key, was part owner occupied, part rented out. So this particular is a property that was going to be offices. And probably about a third of it was going to be owner occupied, and the other third was going to be split up into sort of smaller offices. And traditionally, this is quite a tricky thing to fund. So again, we kind of thought, think outside the box. We could probably go to a Lloyd's or something like that, and they might be able to look at something like this. But the company didn't have that many years worth of accounts, and the property itself probably needed a little bit of work. In all fairness, it definitely needed, aesthetically needed to be brought up to standard, but also obviously just needed to be split up into these various different office sections as well. And so we thought, okay, well, how else could we possibly do this? And what we've definitely been seeing a lot over the last month or so is we're getting contacted a lot by lots of business loan lenders. So traditionally, these would be like invoice financing and all this kind of stuff, which is great, and we've done a fair amount of that over the years. But one thing that a lot of them are branching out into is business loans, but secured business loans, and this is where they can be so much more flexible compared to maybe like a traditional mortgage lender or commercial mortgage lender in particular, where there's all these kind of hoops that we need to jump through. So what we've actually found with this one is Okay, we can go to it's only 50% loan to value on this particular one that we're looking at. But if you consider the fact that it needs work, it's going to be part owner occupied, and they don't have many years worth of trading history that they can show. It's great, and we're looking at about 6% on it. It's not, it's not stupid money by any stretch, and it's doable. We can actually get that, and that's, that a turnaround on that's probably going to be something in the region of about 2.5 weeks, 3 weeks, because there isn't sort of the legality, the level of legalities than there would do on sort of a standard purchase from the finance point of view. And really the underwriting is quite basic as well, as long as they've got a bit of a PG. So the PGs will depend, that's personal guarantees for those not in the know, but the PG will vary quite a lot from lender to lender in terms of how much that they need, but if you think it's between 10 and 100% effectively, as long as they feel comfortable that they can cover that off in the background, great. And like I said, the underwriting can be really quick. We're talking 3 or 4 days sometimes. Those lenders as well, by the way, they actually do unsecured lending, and usually sort of capped at around $250,000. But those sorts of loans, if you meet the criteria, i.e., we can see that you've got a 2 to 3 year trading history and you're looking decent, everything's going in the right direction. You could have funds in your account within 3 or 4 days. That's how quick it is, and realistically to do that, it's usually pretty short forms, and just basically a kind of a projection as well as the previous accounts, and then that lender will determine how much they're comfortable lending to you, and like I said, it's a really, really quick way of getting some funds in the bank. So we're utilizing business lenders, as well as the traditional property finance lenders and mortgage lenders to try and help our clients bridge the gap and just get a little bit of extra cash for certain things that they're doing. Particularly, like I said, sort of the owner-occupier stuff on the commercial side is pretty tricky. It's pretty tricky. And that kind of leads me on as well. A lot of stuff that we're seeing is the mixed use sort of part resi, part commercial stuff, where you might have a shop on the ground floor and then the uppers. And we're looking at one at the moment, which is pretty interesting because they're not actually going to do anything to the property. They're not going to do any work to the property at all. It's like I said, it's a ground floor retail. It's already rented, the ground floor retail, and then there's 2 floors above that are arranged as two bedroom flats. In fact, no, I think they're 1 bedroom flats. Either or, doesn't matter. They're buying the freehold. Now, the vendor was just renting it all out together, but hadn't split up the titles and hadn't created leases for each of them. So what this client's actually doing is they're going to buy the freehold as it is. They're going to split the titles. So there's going to be 3 separate titles, and they're also going to create leases for each of them. By doing that, it actually increases the combined value of the entire thing. And so what we're actually doing is we are, and this is another thing that's really, really interesting, is, and I've done something similar before where it has worked out in this way, but we'll come to that in a sec. On this one, what we're going to end up doing is we're going to put 75% loan to value mortgages on the top 2 floors. What that means is, in terms of paying off the bridging finance that we're going to use to purchase the property with, they only need to get a really small commercial mortgage on the ground floor. Now, commercial mortgages are obviously going to be more expensive. Now, if they didn't split the title and they just went and got a mortgage for the entire thing, they're going to have to go to a commercial lender for the entire thing. Because they've split it, yes, it costs them a little bit of money to do that, but because they've split it, it means that we can just get standard limited company buy-to-let mortgages for the 2 residential properties above, which is fantastic. That's led them to need only, I think, a 45 to 50% more commercial mortgage on the ground floor. Now, there was another deal that I looked at about 2 years ago that was really, really similar to this, and they actually were able to raise funds on the top 2 floors to the extent that they didn't even need a commercial on the ground floor. Basically, the commercial unit on the ground floor was completely unencumbered, which is great because the cost of funds was just so much less, but they're still getting, great income from it as well. So if you can figure that out and you can get that done, great. What's a really, really good thing about this as well is that people don't realise you can actually, depending on the size of the project, sometimes you can actually get funds to cover the cost of doing splitting the titles. Basically, the cost of the legals can sometimes be covered in the bridging loan, which is really, really cool as well. So lots going on at the moment, and loads of really creative funding options that we're looking at. But guys, if any of you are watching, you've got any questions for me, let me know. I'm happy to sort of answer anything that comes my way mortgage related. We've already had Tatiana coming on and asking about second charge mortgages for buy-to-lets, which has been pretty interesting. If you're too late and you haven't caught that, this is going to be saved onto IGTV, so you'll be able to catch up with that later on. But yeah, any questions that you guys have got mortgage related, stick them below, or even if you want to jump on and join me and ask them live, that's absolutely fine. But yeah, so what we covered today, we looked at second charges and buy-to-lets. We looked at 85% loan to value limited company mortgages through Vida. Insane. Hi Johnny. We've also looked at financing mixed use properties and owner occupied commercial. So there's loads and loads going on at the moment. But if there's no questions, that's absolutely fine. I'll be doing this every single Monday from now on until the end of time. So always feel free to either drop some questions. Probably what I'll do during the week is I'll do a couple of stories with like the little question bubble on there, so people can drop me some questions for these in advance, and I can keep note of them, and obviously I can answer them live on these videos. But yeah, so times may vary. It's going to be somewhere between 5 and 7, probably on Mondays. I might even try them in the morning as well. See if anyone's getting up early at sort of 8 o'clock or something like that. Test them out, see which is going to be the best time. I might even do a little story to ask what time people think is going to be the best for me to do it. But if that's everything, if there's no questions, I will leave you all there. I'll leave you to your Monday evenings. Whatever you're doing this week, be amazingly successful. Hey Ronnie, and have a good one. And like I said, any questions you've got, I'm late to join. If you've got a question related to property finance, you're more than welcome to jump in quickly, Ronnie. I was just about to jump off because no one else had any questions. But I was just saying it's going to be Monday from now on, every single Monday, whether it's in the morning, in the evening, in the afternoon, not too sure yet. I'm going to put the feelers out there. But yeah, if that's everything, no more questions, then I will leave you to your Mondays. Have an awesome one, guys, and I'll catch you on the next one. Cheers.